All right, in this video, I'm going to show you why 90% of traders lose 90% of their account and what you can do in order to belong to the top 10% who succeeds. Okay, so there are three reasons why 90% of traders fail. One is lack of back-tested strategy. Two is no risk management. And three, having the wrong psychology. So let's go and dig deeper in each one of them. So, reason for failure number one, lack of back-tested strategy. Well, see, the market changes, right? So, when the market is in a consolidation phase, it's called stage one. And then the market would skyrocket in terms of price, right? That's the stage two. This is where we want to buy. And then the market will top out and, you know, can sometimes have that double top in there. And then it will crash back down. This is called stage four. And then now it will start to consolidate again and begin another stage one and so on. Okay. Now, here's the question. Which stage of the market do you want to focus on? Or what's your backtested strategy in each stage in the market? Do you have one? If you don't, you need to figure it out. You need to have a backtested strategy that works in each of these market cycles. Now, let's say you only want to focus on stage two, that's fine. And then you can decide that, hey, if it's stage three or stage one or stage four, I'll just be in cash. And that's okay too, right? But you got to decide, you got to do your research and actually get the data and back test it so that you will have a robust back tested strategy that you know for a fact, right? It is going to be profitable. So, for example, how do you know when you are in stage two? Well, one way to know that is if your 10 EMA, 10 period exponential moving average is greater than the 20 period exponential moving average, meaning the short term is higher than the medium term, right? Meaning it's trending up even in the short term and your price is greater than your 50 EMA, meaning your price is higher than the long term, right? So now you know that you're in stage two. So there are strategies that will work in stage two, but not in stage four, right? So now part of having a backtested strategy is that it has to be based on lots of data, right? And as much as possible based on mechanical entry and exit rules. So your entry and exit rules have to be very precise, right? And then you test it, right, using the market data and then see what happens. Now, yes, it's going to take a lot of work, right? But the work and effort is worth it. Okay, so for example, here's a screenshot of our day trading strategy that we back tested. Okay, it has a win loss ratio of 2.335, right? A win rate accuracy of 72%, which is crazy, right? The average win is more than twice the average loss, all right? For a 14% expectancy. These are huge numbers, okay? When you have huge numbers like these, right, then now you can have conviction and then you can size in when you know that you have a robust, back-tested strategy, all right? Now, reason number two for failure is no risk management. And what does that mean? Well, why should you manage your risk? Well, if you cut your losses, you can survive until you thrive. Let's say you don't have a back-tested strategy yet. The worst thing that you can do is to just trade, which is basically like gambling, you know, um, and then you don't have any risk management at all. Some traders, whenever they make a little bit of money, let's say 10%, then they immediately sell, right? They immediately take profits. And then, when a position is losing, let's say it has already lost 20%, the thinking is, you know what? I don't want to sell because what if it goes back up, right? So, but it doesn't, right? Sometimes, the 20% loss becomes a 50% loss or even an 80% loss or even 100% loss, right? So that's why, you need to, and so in other words, they cut their winners short and they let their losers run, right? Which is the exact opposite of what you want to do. And let me prove it to you. Okay? So, one of the ways, once you have a back tested strategy, you got to run it, in this thing called Monte Carlo. So, in a Monte Carlo simulation, right, it will test your parameters of your back tested strategy, right? It will do that 10,000 times, all right? And then what you got to do is you want to look at the worst case scenario. Because if your strategy survives the worst case, and in fact, not just survive, but actually thrives, then you know for a fact it's a very robust, back tested strategy, right? And here, let me show you the impact of controlling your losses, right? So, which one is better? Having a 55% win rate with a win-loss ratio of 1 is to 1, let's say you lose $100, and then you win $100, you lose $100, you cut the trade, you win $100, you cut the trade, right? So is that good? 55% win rate on a win-loss ratio of 1 is to 1, or 60% win rate, meaning you win more than you lose, but you lose more than you win, meaning a win-loss ratio of 0.8 is to 1. Okay? Or, your win rate is even lower than flipping a coin, right? Only a 40% win rate, but you let your winners run so much so that your winners, right, is two times higher than your losers on average. So which one do you think will work? Well, let's see. So I ran the Monte Carlo simulation so that you don't have to. And in this simulation, you're risking 1.5% of your account every time you trade. All right, and this is over a 48-month period, meaning over a 4-year period. This is what happens with the 55% win rate, 1 is to 1, win loss ratio. Right, it is basically you're up slightly by 25.9%. And again, this is over 4 years, right? I mean, you might as well just put your money in the S&P 500, to be honest, right? Instead of having only a 25.9% return over those 4 years. You would have been better off just putting your money in the S&P 500. As the time that I recorded this, for the past 5 years, the return of SPX is about 88%. So that's a lot better than 25.9% in 4 years. All right. Now, what about 60% win rate but you don't control your losses, meaning your win is 20% less than your average loss. Then what happens? Well, in here, you actually lose money. You lose 19.1% of your account. Okay? Even if you have a high win rate. But the problem with the high win rate is that if your losses are not controlled, right? Your losses are bigger than your wins, then it doesn't matter, right? You will lose in the long run. And look at the maximum drawdown, almost 65%. And again, this is the worst case scenario. But guess what happens? Even if your win rate is lower than flipping a coin, only 40%, but you let your winners run so much so that your average winner is two times more than your average loser. Guess what happens? Now your return is 232% in just 4 years, easily beating the S&P 500, right? So this is the power of controlling your losses, keeping your losses small, and letting your winners run so that your winners is two times more than your losers. Okay? So now the last reason why most traders fail is having the wrong psychology. What does this mean? Well, every time you trade, there's a balance between fear and greed, right? If you have more fear than greed, then maybe you will not trade at all because you're afraid, right? Then you're going to miss out on those opportunities. Next, you will cut your profits too soon. Okay? So, instead of letting your winners run, you cut your profits too soon, right? Then now your win-loss ratio is the other way around, right? And then, let's say you're in the trade, But a sign of fear is when you don't cut your losses because you're thinking, you know what, I'm afraid that I might miss out, right? I'm afraid that if I cut my losses short, what if it turns around and goes back up? So now, the stock would rise without me. Well, that's a sign of fear. So you got to get rid of that, right? You got to work on your fear, right? And then the other extreme is if you have too much greed, right? Then what happens? Well, you just trade without a plan, right? So you're basically gambling. All right, maybe I'll try this. Maybe it will work, right? Well, I can see that my friend Johnny, made money with Nvidia stock. Therefore, I will buy Nvidia, right? That's trading without a plan. You're just listening. You're just being envious of others. You're just following someone else's hot stock tip, right? And then another sign of greed is when you trade without no stop loss, right? You just let your losers run because, oh, you know what if? So again, it's kind of like the same as having fear that you might miss out. It's also a sign of greed because you don't want to miss out, therefore you don't have any stop loss. And then another sign of greed is not taking profit sooner. So, up to a certain point, you gotta take profits, right? Because if you don't, what if it turns around in the other direction? So now you're going to lose money, right? So there gotta be a balance, right? So sometimes what I would do is I would sell into strength. Okay. And then when the market changes or the price changes, and then now, it's going to go in an opposite direction, then I would sell into weakness, right? So, and by doing it that way, you kind of preserve your profit, but you still let it run so that your win loss ratio, your win will be higher than your losses. All right? So, when fear and greed, how do you balance fear and greed? You got to put discipline, right? You got to be a disciplined trader slash investor. So, for example, you got to discipline your fear. And how do you do that? By having a back tested plan and very clear stop loss rules, right? So, your stop loss rules can be a percentage of, the trade or percentage of our position size, right? It can be, let's say, if I lose 10% or if I lose 15%, I'm out, all right? Or if the price of the stock went below this line or at this line or at this price, then I'm out. Okay? So it gotta be very clear stop loss rules. And again, use a back tested plan because if your trading plan is based on data, right? And preferably lots of data. My statistics teacher in college said, something that is less than 30 data points, I mean, that's nothing, right? So you gotta, back test it as many data as you can, at least 30. I mean, preferably it has to be hundreds or even thousands, right? One of the option strategy that I use that is back tested, it is based on 7,000 data points. Okay, 7,000 trades. Think about that, right? So the more data that you have in your back testing, the better, right? Because it builds your conviction. Because what happens is, when you trade, right, the outcome of a trade is sometimes can be random. It doesn't matter. You've done everything right, but yet the trade can go against you. You can do everything right, but then, Donald Trump would tweet something and then the whole market crashes, right? So there are things outside of your control. And the results of any trade is random, right? But if you do it enough times, based on the backtesting that you've done, you are confident that it should give you this result, which is called expectancy, right? So let's say that the day trading back tested plan that I've shown you, right? The expectancy is 14%. So meaning every $1,000 that we put in a day trade, right? It should produce $140 win or lose, right? That's the accumulation of both wins and losses, right? So that's what you want, right? Having a backtested plan based on lots of data, right? With very clear stop loss rules, and then that will rein in your fear, right? Because now you can trade with minimal fear. You will still have fear, right? Because you're still human, but you basically execute your plan and as much as possible, right? Then just leave the emotions out of it. Hey, here's the plan. I just follow my plan, and I have clear stop rules anyway, right? So whenever the price of the stock goes there or my stop loss gets triggered, it doesn't matter what's going on. I have to exit, right? So and having the discipline to follow that, I mean, that will alleviate the fear, right? And then what about greed? Well, you got to be patient for the right market, the right sector, the right stock, right? And having clear take profit rules, right? You got to be clear when you take profits. Are you going to sell the stock, right? When it has grown by more than 25%, for example, right? That can be your take profit rule. Or, when the stock goes up to a certain price, then I exit, right? Again, that's based on a very clear take profit rule, right? So when you have the discipline to implement your plan, right? And again, having a back tested plan with clear take profit and clear stop loss rules, then you will be a successful trader because you can control the one thing that is very hard to control, and that is your psychology. Now, let me show you an actual trade that I did. Um, an option trade in this company, ticker symbol ATI. It is in the right market. When I did the trade, the market is stage two, so it's rising, it's trending up. It's in the hottest sector at that time, which is industrials. And when I look at all the stocks in that sector, I found ATI as a good candidate. And true enough, when I did the trade, right? Well, before I did the trade, I have to have clear stop loss rules, right? So I bought it here where it designated as B, right? And I am very clear that if the price of this stock ATI goes down to this level, around $100.70, I believe, or 101 or something like that, right? Then that's my stop loss. Okay? And then if it goes up higher, let's say to 110, then I will roll. So for those of you who don't know what rolling a call means, it's basically taking partial profits, you know, because what you do is, you sell a call, you sell at a higher price, but the same expiry, and by doing that, you collect a credit, right? You take partial profits, you get because of the credit that you receive, you take money off the table, and then now you take less risk, right? So I have three roll points, one, two, and three, you know and let's see what happened here. So this is when I bought the call. Okay. $100 call expiring January 16, 2026. And when I entered the trade, I entered this on December 12, 2025. Okay. I bought the contract for $11.20 or $1,120. Okay. This is based on a back tested plan. Then what happened was on December 19, exactly 1 week later, the price of the stock went up. Okay? And so I decided to roll the stock. All right? I rolled it from $100 strike price to $105 strike price without changing the expiry date. The same expiry date, January 16, 2026. And by doing that, I collected the credit of basically $409. All right? And it's a realized profit of $201. And then it went up again on December 22. 3 days later, it went up. And so I decided, you know what? Let me sell it. Let me close the position, right? Because I don't want to be 1 week before the expiry date, because then I will have a lot of gamma risk. And again, where's that based on? It's based on a back-tested plan, right? Back-tested strategy. So I exited the trade. I pocketed $1109.98 in credit, right? For a realized profit when I sold the 105 call of $198. So overall, right, it's a total profit of $400 using a capital of only $1,120 for an ROI of 35.71% in just 10 days. That's the power of having a back-tested strategy with clear stop loss, take profit rules, right? And having the right psychology, having the right risk management, and having the right psychology. So, how do you find your edge? Well, again, you gotta master 1 to 2 strategies based on the market, your account size, your risk tolerance, and back test it. Okay? If it's not back tested, don't do it. Until you find a back tested strategy, then you gotta research and you gotta do the work in having a back tested strategy. And then next, you define your risk management, right? Well, again, what's your stop loss? What's your take profit? And as much as possible, it has to be based again on your back-tested strategy. So all of these are all connected, right? And then when you have a back-tested strategy with clearly defined stop loss and take profit rules, right? Then your psychology will be in a lot better place because now you can trade with discipline because now you're not too afraid. There will still be fear, right? But you're not, you can rein in your greed because again, you're basing all your decisions as much as possible, make it as mechanical as possible, right? Based again on your back tested strategy. And by doing these 3 things, you will find your edge in the market and you will succeed. All right. So if this has benefited you, like this video and subscribe. You can always change your mind, right? But if you like this video, this will tell YouTube that you want videos like these. And if you want to know if the market is going to crash in 2026, click on this next video and I will see you there.